Listen, if you blinked, you missed the print. Silver just tagged an official all-time high around $86.22 on spot. Not high for the year, not a breakout, an all-time high. And it isn't floating calmly up there. It's vibrating, oscillating in the mid-80s with extreme sensitivity, like the market has no shock absorber left. That tremor is the tell, because when an asset climbs and then becomes touchy, reacting to every small wave of orders, that's not normal price discovery. That's scarcity meeting urgency. And here's the hook you'll remember. Silver started this run near $30 in early 2025. At the mid-80s, you're looking at roughly 184% in about a year, depending on the exact starting print. That's not a rally, that's a repricing. So the question is simple. Why is silver acting like a door is closing? Take a breath. Because when silver moves like this, it is not about a chart. It's about plumbing. It's about location. It's about who actually has bars to deliver right now. What just happened in the last 2 hours? Picture the screen, gold pushed into record territory, then cooled as profit-taking showed up. Reuters described gold easing about 0.3% after the spike into the $4,600 area. In normal markets, silver follows that gravity. When gold exhales, silver typically exhales harder, but silver didn't. Silver held near the ceiling. That decoupling matters more than the headline, because it's a rare signal the driver changed. Gold is still primarily a macro hedge. Silver is now behaving like a supply-side panic trade. If gold is a referendum on confidence, silver is a referendum on availability. And availability is the one variable nobody can talk down with a press conference. Why $86 feels different than $80 is, here's why your gut is buzzing. When silver cleared $80, it was a headline. When silver cleared $86, it became a stress test. Because above the old ceiling, every short hedger, every industrial buyer, every fund, every ETF desk, and every swap counterparty is forced to reprice the same question: how much physical is actually free, not how much exists in the world. Free, available, deliverable, in the right vault, with the right paperwork, not already allocated to someone else. This is where markets stop being philosophical and start being logistical. The spark, the sell America trade. The immediate catalyst isn't a cute pattern. It's a narrative shock. The Justice Department's investigation into Fed Chair Jerome Powell has lit up a fear that markets hate: institutional instability. Reuters reported the story as a driver behind safe haven demand and a weaker dollar backdrop. And markets don't price morals, they price uncertainty. When the world believes policy is boring and rules-based, the dollar feels safe. When the world believes policy can be leaned on, the dollar becomes a debate. So money rotates out of paper promises into things you can't subpoena. That's why silver is catching the bid like a life raft. The second spark, China's export license. Wall now zoom out, because this is where a trade turns into a trap. China's export regime for silver tightened into a licensing system for 2026-2027 with a limited list of approved exporters. This isn't just a policy footnote, it changes the physics of the global market, because licensing doesn't have to be a total ban to behave like one. It creates friction, delays, permissions, surprise rejections, and the one thing procurement managers fear most: uncertainty about delivery windows. And when delivery is uncertain, buyers stop shopping for the best price. They start shopping for the guaranteed metal. That is how an arbitrage gap becomes a vacuum. Multiple market reports have flagged unusually large Shanghai premiums versus Western benchmarks, at times several dollars per ounce. That sounds like trivia until you understand what it does. A premium is a magnet. A premium says, bring metal here. And metal obeys price, especially when paperwork makes the path one way. The mechanics: how a premium drains a region. Let's simplify the plumbing without dumbing it down. If Shanghai is paying more than London or New York, and you are a dealer or refiner with optionality, you do three things. You stop selling cheap into the West. You hold inventory until you can route it where it clears higher. You demand a higher price from Western buyers to compensate for the opportunity cost, even if the metal never ships, even if the export route is slow. The existence of the premium raises the reservation price everywhere. Now add export licensing, now add geopolitical noise, now add a skittish dollar. This is how markets fragment. One price becomes two becomes four, and the benchmark becomes less meaningful. That's why people start using words like decoupling and force majeure. Not because they want drama, because supply chains do not care about feelings. Goldman's warning: why moves are bigger now. Here's the piece most people miss. A demand surge doesn't move silver the same way when inventories are thin. Goldman has warned that persistently thin available inventories, especially in the London ecosystem where benchmark pricing lives, can make silver dramatically more sensitive to flows, creating squeeze conditions and violent swings. Goldman's own research note ties the current era to extreme price action, with 2025's gains described as the largest annual move since the 1979 Hunt era episode. Translation: in a deep market, orders get absorbed. In a shallow market, orders hit the wall. So the same buying pressure that used to nudge silver a couple percent can now shove it far harder, because there's less free metal sitting around to buffer the impact. That matches what you're watching right now: tiny headlines, big candles, and that eerie, high-frequency tremor near the highs. The liquidity vacuum, London, COMEX, and the wrong place problem. Say it clearly: this isn't just a price spike, it's a liquidity vacuum. The world can have enough silver in theory and still have a crisis in practice because the metal is stranded in the wrong places, locked in the wrong form, or already promised to someone else. Goldman's framing has been blunt. The market can stay dysfunctional when physical silver is stuck away from where the benchmark is set. And Reuters has previously reported how much of London's vaulted stock can be tied up as allocated metal, limiting what's actually available to trade. This is why volatility feels like a step function. Because when the free float is small, price becomes a weapon. Let me give you the street version. In normal times, when someone buys a lot of silver, a dealer can hedge, source, and settle. In tight times, the dealer hedges, but can't source. So the hedge becomes a promise that depends on someone else's promise. That is how you go from market to chain, and chains snap. The industrial floor. Why this isn't just speculation. Now we talk fundamentals, the part that turns a spike into a cycle. Silver is not only money, it's wiring, it's solar, it's electronics, it's the quiet metal inside the loud machines. The Silver Institute has documented a multi-year structural deficit, including a cumulative shortfall of almost 820 million ounces across 2021-2025. That's not a one-off squeeze. That's 5 years of inventory draw. And the Financial Times has described the same idea, a persistent multi-year shortfall that makes the market thin, twitchy, and vulnerable to squeezes. Here's the consequence. When inventories have been drained for half a decade, price doesn't need much help to move. All it needs is a spark. AI data centers and electrification don't wait for a dip. They sign contracts, they secure supply, they treat silver like a component, not a trade. So the industrial bid becomes a floor, and the macro bid becomes the accelerator. That's how you get parabolic phases. The 184% moonshot. Why it feels unreal, and why it's real. Let's ground it. If you bought silver around $30 and it's flirting with the mid-80s, your brain refuses to accept it because most people grew up thinking silver was boring, something that moves like a commodity. But the market doesn't care what you're used to. Silver is a small market. It's thinner than gold. It's easier to squeeze. And unlike gold, it doesn't have central banks sitting behind it as a stabilizer. So when the world's confidence cracks and the supply chain tightens, silver doesn't glide. It leaps. That's why the move is violent. And that's why Moonshot stops being a meme and starts being a description. Because the market is not celebrating. It is rationing. The news that makes this more than a trade. Here's the uncomfortable truth. This run is happening while the world is also watching a list of geopolitical shocks stack on top of each other. Reuters has tied the precious metals spike to broader uncertainty, policy stress in the US, geopolitical tension abroad, and that safe haven reflex. When risk rises, money seeks certainty. But certainty in 2026 doesn't mean a politician's speech. It means something that is globally recognized, liquid enough to trade, scarce enough to matter, and physical enough to ignore narratives. Gold does that. But silver adds one more ingredient: industrial necessity. And necessity is relentless. The moment silver leaves gold's shadow. Now you'll hear a lot of people say, silver is just a leveraged gold bet. Sometimes, yes, but not today. Today, silver is telling you it has its own engine. It is being priced like an industrial metal with monetary upside. Like copper with a panic button, like oil with a vault, and the decoupling you saw, silver holding while gold cooled, fits that story. Because when the driver is scarcity, not sentiment, silver can refuse to follow gold's breath. Where the squeeze shows up first. Squeezes don't start with a CNBC anchor yelling. They start with small, quiet tells. Spreads widen. Lease rates spike. Delivery windows stretch. In stock turns into call for quote. And the premium becomes the headline. The market becomes less about price and more about terms. That's why Shanghai premiums matter. That's why London inventories matter. That's why export licensing matters. Because all three squeeze the same artery, availability. The receipts. This move didn't start today. If today feels like a bolt from the sky, it's because you're seeing the final stage, not the buildup. Here's the staircase. June 2025. Reuters covered silver pushing above $35 and hitting multi-year highs, already supported by industrial demand and persistent deficits. October 2025, Reuters described a London squeeze dynamic where borrowing costs and location mismatches made the spot market dysfunctional and highlighted how much vaulted silver is allocated and therefore not freely available. Late 2025, Reuters also reported shortages and local premiums in India, the world's largest silver consumer, as imports tightened and demand surged. December 26, 2025, Reuters printed a record-high silver price near 78.5 in a single-session surge. Early January 2026, Reuters noted silver had already notched fresh records again after a monster 2025 performance and flagged the export license theme as a supply concern. January 12, 2026, Reuters reported another record jump in silver alongside the Powell investigation narrative. Now, spot tags the mid-80s, with Trading Economics listing an all-time high around 86.22. So no, this isn't random. This is 5 years of deficit pressure meeting a market that finally ran out of patience. The ratio signal. Why silver can outrun gold. When silver is just gold's shadow, the gold-silver ratio tends to drift higher. But when silver gets its own bid, the ratio compresses. Reuters noted in mid-2025 that the gold-silver ratio was already falling from earlier extremes, reflecting silver's relative strength. That matters because it's a mechanical tell. Ratio traders lean into silver when it starts outperforming, which amplifies moves in a thin market. And Reuters has pointed out the broader pattern. Silver often delivers higher percentage gains than gold because it's smaller, thinner, and more prone to squeeze dynamics. So when you see silver refuse to follow gold down on a profit-taking hour, you're watching that ratio trade flip from idea into force. Why inventory is a trick word. A lot of people hear there are thousands of tons in vaults, and they think, then why would price spike? Because most of that metal is not a pile with a for sale sign. It's already spoken for, allocated to ETFs, held for central counterparties, sitting as industrial working inventory, or parked in regions where moving it costs time, money, and permission. Reuters explicitly highlighted how much of London's vaulted stock can be allocated, leaving a much smaller pool of metal that actually trades. That's why the market can look full on paper and empty at the counter. Think of it like hotel rooms. A city can have 50,000 rooms. If 49,000 are booked, the available number is what sets the price. Silver is pricing the available number. The two prices theory, screen versus metal. Here's a practical way to understand what's happening. Screen price is the price of a contract. Metal price is the price of a guaranteed bar, delivered on time. In calm markets, those two prices sit close together. In stressed markets, they separate. That separation is exactly what the export license story and the thin inventory story create. Western benchmarks reflect paper liquidity. Eastern premiums reflect physical urgency. And when the gap persists, it doesn't just predict higher prices, it forces higher prices because it punishes anyone who sells physical too cheaply. This is why a premium doesn't need to last forever to do damage. It only needs to last long enough to change behavior. If you want the honest truth, here it is. If silver can move this far, this fast, it can also rip your face off on a pullback. Goldman's warning is not up only. It's extreme swings in both directions when the market is thin. So the goal is not to feel smart. The goal is to stay alive. Okay, now we can talk about what breaks it. The comics question, delivery nightmare. Without the drama. You've probably heard the phrase, COMEX delivery nightmare. Here's what that means in human language, without conspiracies. Futures markets are built on the assumption that most contracts net out in cash or roll forward. Only a fraction demand delivery. That works, until physical becomes the bottleneck. When industrial users, funds, and dealers all decide they want the same thing at the same time, bars, not paper, the system gets stressed in three ways. The hedge problem. Dealers can hedge price exposure instantly. They can't create metal instantly, so hedging becomes easy while sourcing becomes impossible. The timing problem. Even if metal exists, it has to be refined to spec, moved to the right vault, cleared, insured, and settled. That's weeks of reality crashing into seconds of trading. The location problem. If the cheapest silver is priced in one region, but the urgent demand is in another, the spread widens, and the spread widens because time widens. This is why premium is not just an extra fee. Premium is the price of time. Why arbitrage can fail. In theory, any big gap gets closed by arbitrage. In practice, arbitrage requires legal permission, shipping capacity, financing, insurance, and confidence. The rules won't change mid-shipment. When China adds export licensing and the market senses uncertainty, that confidence erodes. And when London's readily tradable pool is thin, even small disruptions can create outsized moves. That's how you end up with sticky dislocations. The gap stays open long enough to pull real inventory across the globe. Shanghai's role, a benchmark that demands metal. China's Shanghai Gold Exchange publishes a silver benchmark in local terms. You don't need to convert every digit to understand the point. The benchmark reflects a market that is closer to physical settlement culture. So when physical urgency rises, Shanghai can show it faster, and the premium becomes the signal flare. That's why Western traders keep glancing east, not because they worship Shanghai, because they're trying to see the real clearing price for actual bars. The psychology of $100. Why round numbers become gravity. Now let's talk about the number everyone can't stop whispering, 100. Round numbers do two things. They create fear for shorts, and they create permission for longs. Because at 99 out of 50, people feel like it's basically there. And at 150, people feel like it's officially a new world. Reuters reported Citi explicitly lifting short-term projections toward $100 silver. That matters because it shifts the social narrative from could it to when. And in thin markets, narrative is fuel. The cleanest confirmation signal. If you want one clean mechanical confirmation that this is still supply-driven, it's this. Watch whether dips get bought immediately in the physical narrative while paper liquidity whips around. When gold dips and silver refuses, when premiums hold even during red candles, when availability becomes the first word out of every desk's mouth. That's not a normal bull market. That's a rationing market. And rationing markets don't end with a quiet shrug. They end with a violent decision. Either supply loosens and price cools, or enters, supply stays tight, and price surges higher until demand breaks. That's the game. What can break this move? Yes, it can break. If you're here for honest analysis, you need to hear the other side. Parabolic phases are powerful and fragile. This can cool off if metal flows back into the pricing hubs and inventories rebuild. Goldman has noted that if silver returns to London, the squeeze dynamics can ease, reducing the market's sensitivity. Policy uncertainty fades, and the dollar stops bleeding narrative confidence. The Powell story is a catalyst because it hits belief. If that belief stabilizes, the rotation can slow. Futures conditions tighten, margins rise, liquidity dries up, and leveraged longs get shaken out. Even without a conspiracy, exchanges raise risk controls when volatility explodes. That's mechanical. So don't fall in love with a candle, respect it. Citi's signal. When targets chase price. When banks start chasing price, it's not because they suddenly love your metal. It's because their models are being forced to admit the tape is stronger than the assumption. Reuters reported Citi revising short-term forecasts toward $100 silver and $5,000 gold amid strong momentum. Now, do targets cause price? No. But targets do one thing. They authorize attention. They give big pools of money permission to say, okay, we can talk about triple digits out loud. And once triple digits enters the conversation, psychology changes. $86 isn't expensive. It becomes still below $100. That's how late cycle narratives work. The bigger frame, this is what a reset looks like. Here's the simplest frame I can give you. For years, the world treated silver as abundant enough to ignore. A metal you could always source. Eventually, somewhere. But 5 years of deficits change that math. Export friction changes that logistics. And a policy institutional shock changes the risk appetite. When all three align, price stops behaving like a normal commodity. It behaves like a reset. A reset is not a straight line. It's a series of violent steps, up, down, with the trend still up, because the underlying constraint is real. What to watch next? The signals that matter. If you want to know whether this is continuation or climax, watch the plumbing, not the pundits. The Shanghai premium. If the East keeps paying up, it keeps pulling metal. London availability. If the free pool is thin, flows matter more and price stays twitchy. Volatility tone. Goldman's message is basically expect extreme swings in both directions when the market is thin. The dollar narrative. If the Powell probe keeps feeding an institutional crisis storyline, the rotation into hard assets stays alive. Any sign the export regime loosens or the licensed flow increases. If paperwork friction reduces, the premium can shrink. The battle plan. No panic, just process. Here's the part I want you to tattoo on your brain. In parabolic markets, your enemy is emotion. So whatever you do, do it with rules. If you trade paper, assume the market is trying to shake you out. Position size accordingly. If you stack physical, remember the real premium is the ability to actually get it when the screen price lies. If you're new, don't confuse speed with safety. Fast up can become fast down. If you're long term, zoom out. The thesis is not up only. The thesis is tight market plus structural demand. And most importantly, stop treating this like a normal commodities chart. This is macro plus supply chain plus policy shock, all at once. That's why silver is acting like the world is running two prices, one for the screen, one for the metal. The story. In one sentence. Silver isn't going up. Silver is being repriced because the market is discovering the buffer is gone. Remember this chain. Record print. Spot around $86.20. Decoupling. Gold cools, silver holds near highs. Confidence crack. Powell probe fuels sell America rotation and a weaker dollar tone. Supply friction. China's export licensing adds delay risk and raises the reservation price. Thin buffer. London's available pool is constrained. Flows hit harder. Structural floor. Roughly 820 MAS cumulative deficits, 2021-2025. Keep inventories tight. Target chase. Citi openly talks $100 silver, which changes the psychology. Now the only question is, does supply loosen before price tests 3 digits? If you want me to track the premiums, the vault stress, and the policy headlines in real time, hit subscribe and comment. Track it. One last note. Parabolic markets punish overconfidence. If this cools, it won't be polite. Your edge is patience, not prediction. Stay sharp and keep your risk small, always. Silver at $86 isn't the end of the story. It's the market telling you the old assumptions are breaking. The last 5 years were a slow drain. Now the drain is obvious. And when it becomes obvious, the crowd arrives. So here's my question to you. If the price is this sensitive in the mid-80s, what happens when the world starts trying to secure supply at $100? Drop a comment. Do you think this is a blow-off or the opening act of a full re-rating?